Bill, if you might comment as well, interest rates at this point, the great question is, when's the Fed going to lower interest rates? I'm assuming that's increasing some of the operating costs for the projects and also perhaps the time before a project might sell. So you might weave that into the conversation as well, please.
Yeah, I think that it's worth mentioning to everyone on the presentation that there are benefits associated with New York Life and Protective Life, and especially a long-term relationship with Protective Life that allow us to access capital that is below where the market's trading right now. So right now, if you were to go out and borrow a typical construction loan from a community bank or even a super regional for that matter, that rate is about 7.5%. We just signed a commitment from Protective Life at 6% for a deal as well. So if you think about it, we are able to access capital about 150 basis points cheaper than the market. And so it puts us in a position where we're taking less capital risk, and we are effectively creating more margin by virtue of long-term relationships with institutional players. So interest rates have moved on us, and it's always incumbent on us, right, to determine whether or not we've got adequate margin and runway. So let's talk about that for a second. The Fed moved interest rates 500 or so basis points, right, over a short-term period of time. And the folks that really got in trouble was a lot of folks that are in other real estate sectors that was utilizing short-term floating rate debt. All right, so we put out a press release earlier this year. Lightbox, we have never done a single floating rate debt deal. We have everything within our entire portfolio is fixed rate in nature, and we don't have a maturity until 2027, 2028. So we're really a good posture with our debt capital stack. But the part about what's unique about where the market is right now with interest rates moving 500 basis points is, can you as a company still make money and be profitable and be innovative and adaptable to a changing environment? And so what's important to recognize at Lightbox is we, couldn't do a full sweep, figure it all out at once, but little baby bite chunks that we've taken, little strategic steps we've taken in order to create margin, in order to be able to uphold these same return levels. And this is something that was very impressive to some of our institutional partners. So step one was we said, all right, can we put ourselves in a position to lower expenses? And in self-storage, the heaviest expense burden outside property taxes is payroll. That payroll burden is usually $100,000 to $108,000 a year. Well, if you put that on your standard 6% cap rate on your exit, what's $100,000 worth? About $1.6 million. So it's a significant amount of money. What we did is we bought a remote management company 6 months ago. So that is an unmanned remote management operation that is now integrating into our properties right now and will allow us to completely remove that payroll burden. So once again, expenses down, margin has increased. Second thing we did, right, by aligning with institutional partner is our cost of property insurance, right? Gone down pretty significantly. Margins have increased. The third part I think about what we've done is really just the efficiency of the Lightbox building in and of itself. We've been able to continue to whittle down on the steel package and continue to enhance the unit mix. And then the second part that's really important, and once again on this idea of adaptability, is we have integrated boat and RV storage on our last couple of builds that we're not sure we want to do that in a wholesale manner just yet. The demand is seemingly endless. But we have been, like at Vero Beach, we did our typical prototype, but we did about 180 or so boat and RV parking spaces. Now, what you like about that is that you can do parking spaces, outdoor parking, you can do canopies, or you can do enclosed garages with electricity and the whole 9 yards. What we like about that is the parcels that we're buying now allow us to build our 3-story prototype and then have a little residual piece for boat and RV. Again, a little bit accelerant to the pro forma, and again, allow us to give margin when interest rates have taken away some of that margin.